The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program, set up in 2003, and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding loans and credit. This is the first video in a series of 4. In it, we will focus on the different categories of loans and their features and relevant costs. Why do people borrow money and incur debt? Debt can be divided broadly into 2 categories: unavoidable and avoidable. Unavoidable debt refers to borrowing for necessary and costly expenditures, like buying a home, paying for medical-related emergencies, or in the immediate aftermath of loss of a job. On the other hand, avoidable debt is typically a result of poor money management, impulse buying, and living beyond one's means. According to Credit Counselling Singapore, here are the top reasons cited for indebtedness. Job-related, 46%. Supporting family, 44%. Overspending, 41%. Business-related, 22%, and medical, 18%. The percentages add up to more than 100% because people often get into debt for multiple reasons. Loan categories. Loans can be categorized as either secured or unsecured. Secured loans refer to those that are backed by assets pledged as collateral. If the value of the asset or collateral falls below a certain percentage of the loan amount, the borrower may have to top up, either using cash to reduce the outstanding loan or pledging more assets. If the borrower defaults, the lender can sell the assets. Because there is security provided by collateral, interest rates for secured loans tend to be lower compared to unsecured loans. Unsecured loans, on the other hand, refer to those made without any collateral. Because the lender does not have any collateral to fall back on, interest rates tend to be higher. Loan categories. Term loans and credit facilities. Term loans refer to those that are for a defined term or period. They can be secured or unsecured. Term loans can also be categorized by tenor. An example of a secured term loan is a home loan, where the term is the repayment period, usually up to 25 to 30 years, and the collateral is the house that is being purchased using the loan. Unsecured term loans would be personal loans, such as for education or renovation. Credit facilities are typically short-term, usually less than a year, and the borrowing can be secured or unsecured. The most common type of secured credit facility borrowing is a bank overdraft, where the assets pledged as collateral could be shares, bank deposits, or property. Note also that overdrafts can also be unsecured. Zero-interest payment schemes and buy now, pay later plans are also examples of unsecured debt. Features and costs of loans. Term loans are usually larger in amount and have longer repayment periods. Repayments are usually made in installments over the term of the loan or in full at the end of the period. The loan can be recalled by the lender if the borrower breaches the terms of the loan agreement. Cost of borrowing. When considering the costs of borrowing, take into the account the interest payable, fees, and charges associated with the loan and third-party costs, if any. Types of interest. Note that for all loans, the longer the tenor, the interest payable will be more for the same amount borrowed. A flat rate of interest means the rate is applied upfront and added to the loan amount, for example, in car and personal term loans. Monthly rest interest refers to interest calculated based on the monthly outstanding balance. This is usually the case for home loans. For any given rates of interest, a loan with a flat rate will be more costly than a loan with a monthly rest interest computation. For fixed interest rate loans, the rate charged is fixed throughout the lock-in period. One example is the fixed-rate housing loan. For floating rate loans, the interest rate charged may go up or down, depending on the benchmark, which is usually the Singapore Overnight Rate Average, or SORA. For flat rate interest, are you paying exactly what you see? The effective interest rate, or EIR, is the true interest cost for a loan. A loan with interest charged at the flat rate method will have a higher EIR compared to one on a monthly or annual rest method. For example, for a $90,000 car loan on a 2.5% per annum flat rate, the EIR will be 4.84% per annum. The EIR for any loan is also impacted by the frequency of installments required. A loan with more frequent installments will have a higher EIR than one with fewer installments. Fees and charges. Apart from interest expenses, taking a loan may also come with the following fees and charges. Processing fee. Amendment fee, if the terms or the original application need to be changed. Cancellation fee, if the loan is not taken up after acceptance. Late payment and default charges, in case of failure to meet payments when they are due. A prepayment charge, if the entire loan or part of it is repaid before it is due. Some loans may impose this charge for the entire duration of the loan, while others have a lock-in period, after which no prepayment charges apply. Third-party costs range from valuation fee to be paid to a professional appraiser, legal fee payable to a lawyer, stamp duty payable to the government, and insurance premiums for coverage against fire and other damages. Credit facilities can refer to the use of credit cards, borrowing through a bank overdraft or personal line of credit. For credit cards, the advantage is that purchases can be made without immediate cash payment up to the credit limit, which is usually 2 to 4 times of your monthly income. However, if payment is late or only made partially, the interest charged is 24 to 28% per annum. Bank overdrafts or personal lines of credit can be granted on a secured or unsecured basis. The borrower is usually given an overdraft limit of 2 to 4 times monthly income. Costs involved in using credit facilities include late charges or penalties if the minimum sum is not paid by the due date, annual fee, card replacement fee, cash advances or withdrawal fee, processing fee for personal line of credit. Here are the key takeaways. Try to live within your means and avoid excessive borrowing. Unsecured loans charge higher interest. The longer the repayment period, the more interest will be paid. For flat rate loans, the effective interest rate, or EIR, is the actual rate of interest you are paying.